Greetings, fellow traders. I'm Dylan, a research strategist at Pepperstone, presenting the latest weekly update on As Good As Gold. So over the past week, gold has been stuck in a holding pattern, with neither the bulls nor the bears showing much muscle. The market's hawkish repricing of the Fed rate cut has been weighing on gold prices, but still increasing demand for safe haven assets amid concerns about the U.S. economy and robust physical demand from China have provided some solid backup. Traders are now awaiting some hints from Wednesday's FOMC meeting regarding rate cuts and keeping a close eye on Friday's nonfarm payroll report for any potential market shakeups. So now let's take a closer look at the recent gold against US dollar daily chart. We see that after taking a tumble last Monday, gold hasn't quite found its groove yet. It seems like the market is feeling a bit indecisive. Nevertheless, gold managed to find some sturdy support around the $2,300 mark. Looking ahead, breaking past $2,400 will be a psychological hurdle for further upward movement, while $2,300 might provide a safety net if bearish pressures intensify, with $2,200 marking the upper boundary of March's consolidation range, likely attracting more buying interest. While the current standoff between the bulls and bears is due to conflicting factors pulling in different directions. So on one hand, the March U.S. core PCE year-on-year growth remains steady at 2.8%, slightly higher than the consensus, leading the market to kind of push back expectations for the first Fed rate cut to December and a total cut of only 34 basis points by year-end. This supports the U.S. dollar performance and puts a damper on gold prices. While on the flip side, first quarter GDP growth in the US fell significantly short of expectations at 1.6% quarter-on-quarter, rising concerns about, stubborn inflation and slowing economic growth, potentially fueling fears of stagflation. Additionally, another failure in the US banking sector, with 32 branches of Republic First Bank being taken over alongside the looming US presidential election, has heightened risk aversion and boosted gold's appeal. Well, furthermore, actually, when delving into gold analysis, we often just tend to overlook the significance of physical demand amid the macroeconomic noise. However, gold's ability to hold steady above $2,300 is largely attributed to strong physical demand in China and substantial central bank purchases led by the PBOC this time. So, according to the latest data from the China Gold Association, China's gold demand in the first quarter saw a 6% year-on-year increase, with demand for bars and coins rising by 27%. And China's central bank gold reserves have been on the rise for 17 consecutive months, and given that gold makes up less than 5% of China's total reserves compared to a global average of 15% and as high as 70% in the US, there's still plenty of potential for further gold purchases by China. With such robust physical demand and active central bank purchases, the downside for gold prices seems limited. So in summary, the gold market is currently in a consolidation phase. The market's hawkish outlook on Fed rate cuts has been pressuring gold prices, but increased demand for safe haven assets and hefty gold purchases from China have kept gold prices buoyed at a relatively high level. Looking ahead to the remainder of this week, traders should keep a close watch on tomorrow's FOMC meeting and Friday's U.S. nonfarm payroll report. While the Fed is expected to maintain rates unchanged, a more hawkish tone in this statement amid persistent inflation could cause ripples in the market. While the nonfarm payroll report may trigger more significant volatility, market consensus expects an addition of 243,000 jobs, lower than last month's 303,000, with the unemployment rate holding steady at 3.8%. Considering Powell's statement in March that the robust labor market itself wouldn't pose policy normalization, but unexpected weakness could prompt greater policy support. If the unemployment rate unexpectedly rises or there's a significant downward surprise in new jobs, it could just lead to earlier rate cut expectations, a weaker dollar, and stronger gold. So that's pretty much my thought about gold. What's your take on the next move in the gold market? Do you think it will go up, down, or just continue to consolidate? Share your thoughts in the comment section below. Stay tuned with Pepperstone for more insights and updates. And until then, happy trading!